Silver didn't just open higher today. It jumped, took out 86.3, ran straight into the exact resistance zone we mapped at 87.8, and got slapped back from that level almost to the cent. That's not random. The real question now, did that rejection just build a launch pad for the next leg higher, or did it mark the trap that will wipe out anyone chasing late? Silver gapped higher on the open, taking out 86.3 and pushing all the way up to 87.8, and then got rejected right from the resistance zone we had already mapped in advance. That level held exactly as defined, not after the fact, not a coincidence. The level was on the table before markets even opened. If you're new here and you think this is being called retroactively, scroll back through the prior posts and levels. The timestamps don't lie, and that's the point. This is tape reading education for the people who do short-term trading or are learning how to read the tape. Not signals, not advice, just the structure as it existed and then played out. Gold did the same thing, moved higher, exactly in line with what the PXG signal was already showing before Western markets even opened. That signal went up on X well ahead of the open. RateScope on X, same handle as YouTube. Go verify it yourself. The post is still there with the timestamp. And that is precisely why being on X matters. I don't sell anything. Not here, not there, nothing. There is genuinely nothing in it for me. But there is something in it for you. If you want data early, before the market has already moved, that is the only place it happens in real time. Videos take time. By the time this uploads, the move has already happened. That's just the reality of how this works. Now, base gold is sitting at $5,150 as I'm recording this. Silver, Western Spot, and futures are both at $86. And here is where the setup for the next move becomes critical. For silver to continue toward 92, we need to clear that 87.2 to 89 zone with aggression. Not slowly, not with consolidation. Price camping inside that area kills momentum. It invites the shorts to reload. What we need to see is decisive, forceful price action that doesn't give that zone time to breathe. That's the structure. Watch for it. But here is what makes tonight's session unlike any other this week. And this is where the story gets serious. Shanghai reopens tonight, and the market that greets it is not the same market it left before the Lunar New Year holiday. Western prices have caught up significantly during the time Shanghai was offline. So the question every informed participant is asking right now is, where does Shanghai open? And the answer might already be sitting in plain sight. China's largest silver recycling firm, one of the biggest scrap buyers in the entire country, was offering to buy back 99.99 silver at roughly $95 to $96 per ounce on Monday, on a day when Shanghai itself was still closed. That is not a rumor. That is a business making a real cash offer for physical silver at a price nearly $10 above where Western Spot is trading right now. When the largest recycler in Shenzhen is paying that kind of premium to source physical metal during a holiday closure, you are not looking at speculative sentiment. You are looking at genuine physical demand expressing itself in the most direct language a market can speak: price. If that recycler's pricing is any indication of where Shanghai physical demand actually sits, tonight's open could be something the mainstream financial media will scramble to explain after the fact. The ones who verify these things don't need CNBC to connect the dots for them. But the significance goes beyond the price level. The underlying structural picture for silver is unusual and warrants attention. There are naked short positions stuck in silver. Not a theory, the data shows it. The COMEX implied volatility index for silver, this measures how much the market expects silver prices to swing over the next 30 days based on what traders are actually paying for options, just spiked massively. Think of it like a fear gauge. When that number sits low, markets are calm and orderly. When it spikes to the levels we're seeing right now, the market is pricing in violent, unpredictable moves ahead. It's not telling you which direction. It's telling you the structure underneath is under stress. And that stress has a specific source. The naked short positions in silver are a structural problem that charts cannot fix. Only forced liquidations will. That's not a hot take. That is how commodity market mechanics work when shorts are caught without physical metal to back their positions. And the situation is reportedly complicated further by the fact that there are shorts trapped at the Shanghai exchange as well, with limited ability to hedge on both sides simultaneously because of the capital requirements involved. The market, in other words, is not just tight on the surface. It is structurally compressed in ways that paper pricing has not yet fully reflected. Charles Kindleberger, in Manias, Panics, and Crashes, documented how structural imbalances in commodity and financial markets build quietly for extended periods, and then release violently when the pressure finds an exit. The exit isn't always predictable. The timing isn't always clean. But the release, when it comes, tends to be sudden and severe precisely because the pressure was accumulating while the surface looked calm. And there's another layer of manipulation worth flagging because the pattern has shifted. The large, visible silver price slams that characterized previous suppression attempts have become less frequent recently. What is appearing instead is a pattern of activity in silver futures options that appears designed to achieve the same price management effect, but through a different mechanism. This one is harder to spot, harder to attribute. Implied volatility spiking massively in that market is consistent with that kind of activity. It's worth watching. Verify the CME data yourself if you want to see what's happening in real time. Now, Mexico. The situation there has evolved, and it matters for silver specifically. Eleno, the leader of one of Mexico's most powerful cartels, was killed in a military operation on February 22nd. The immediate aftermath was chaos, airspace shutdowns, road blockades, military mobilization, and the Mexican government has been explicit about coordinating a national response with U.S. intelligence support. On the surface, that sounds like stabilization, and in the short term, it may be. But here's what history shows about cartel leadership takedowns. They don't create instant stability. They create fragmentation. And fragmentation, in regions where mining operations depend on predictable security, is its own risk. You get kidnapping of miners, extortion rackets that inflate operating costs, investor hesitation that follows uncertainty. Those don't disappear when a single leader is removed. They often intensify temporarily as power structures reorganize. Mexico remains the world's largest silver-producing country. Roughly 1 in 4 ounces mined globally comes from that soil. Any sustained disruption to mining security is a supply input risk into a market that is already structurally tight. The situation deserves continued monitoring, not a checkbox that says, resolved. Meanwhile, the geopolitical backdrop has not simplified. U.S. military assets, carrier groups, cargo aircraft, continue to position in the Middle East at levels not seen since 2003. The Iran situation has not resolved. It has paused. And pauses with that kind of hardware in place have a historical tendency to unpause. When geopolitical risk of that magnitude sits unresolved, it embeds a risk premium into gold pricing that doesn't disappear until the risk definitively goes away. Right now, it hasn't gone anywhere. What we're watching is capital moving in real time. Precious metals are surging. Stock market futures open negative. Gold is adding meaningfully to recent significant gains. Silver is up over 2% on the day, while equity markets are pointing lower. That divergence, hard assets rising while paper markets fall, is not random. It is investors making a judgment about where safety lives. And that judgment, once it accelerates, tends to feed on itself in ways the original headline doesn't fully explain. Here is the honest case for caution. This channel doesn't exist to hype you into positions. It exists to arm you with reality. The silver volatility spike cuts both ways. High implied volatility means the market is pricing big moves in either direction, not just up. A forced liquidation of shorts could spike price violently higher. But a coordinated bank intervention, or a liquidity event in another asset class that forces selling across the board, could push silver down just as fast, at least temporarily. Shanghai's reopening tonight could come in at a massive premium, confirming everything the recycler data suggests, or open with more caution than expected as Chinese institutions assess a market that moved significantly while they were offline. And the Mexico situation, while structurally significant, has not yet produced a documented supply disruption in actual mine output numbers. The risk is real. The current impact on supply data is not yet confirmed. Mark Douglas, in Trading in the Zone, talked about probabilistic thinking, understanding that even the highest conviction setups carry uncertainty, and that edge comes from being right about probability over time, not from being right on every single outcome. The structural thesis for silver is as strong as it has ever been. The timing of when that thesis fully expresses in price is a separate question. Anyone who tells you they know the exact date is not doing analysis. They're doing something else. The counter is just as compelling. Everything that was true about this setup yesterday is more true today. The Shanghai recycler data gives us a rare, direct look at where physical demand actually prices metal when the exchange is closed. The COMEX volatility spike is telling us the options market is bracing for something. The naked short structural problem hasn't been resolved. It's been building. Gold at $5,150, while equity futures open red, tells you exactly where institutional capital is choosing to park itself right now. Here's what this all points to. Shanghai's open tonight is the most important price signal of the week. Watch it. The recycler data suggests physical demand in China is running well above where Western paper is priced. If that gap confirms at the open, the resistance zone between 88.2 and 89 on Western silver becomes the only structural obstacle between current price and the next leg higher. That zone needs to be cleared with force, not tested gently, not slowly absorbed, not camped inside. Force. Verify the CME volatility data. Look at the Shanghai recycler pricing. Track where Shanghai opens. Compare it to where Western spot is trading. The ones who do that homework will understand what's happening here without needing anyone to explain it to them after the fact. This is financial warfare education, not advice. Invest with logic, not hype. RateScope out.